Iowa Life and Health Insurance Test, speculative risk. Involves the chance of both loss or gain. Whole life insurance. Insurance that is kept in force for a person's entire life and pays a benefit upon the person's death, whenever that may be. An insurance company only has how many years to challenge the validity of a life insurance contract? 2 years. Suicide provision. Most life insurance policies provide that if the insured commits suicide within a specified period, usually 2 years after the issue date, the company's liability will be limited to a return of premiums paid. Spendthrift trust clause. Prevents the beneficiary's reckless spending of benefits by requiring that the benefits be paid in fixed installments. Reduced paid-up option. Policy owner takes a paid-up policy for a reduced face amount of insurance. Policy owner does not make any more premiums and still retains some amount of life insurance. The cash value is used as the premium for a single premium whole life policy at a lesser face amount than the original policy. Interest-only option. Insurance company holds proceeds for a specific period of time, at regular intervals, pays the beneficiary a guaranteed rate of interest on the proceeds and then are paid out at the end of a specific period. Non-forfeiture options. The options available to a policy owner who would like to discontinue or cancel a policy that has cash value. Can a minor be listed as a beneficiary? Yes, in some cases the proceeds may be paid to a guardian, be placed in a trust, or be paid out when the child reaches adult age. Reciprocal insurer. Insurance company characterized by the fact its policyholders insure the risks of other policyholders. Misuse of premiums. Diverting premiums for personal use. What 3 general factors that help determine the premium of a life insurance policy? Mortality, interest, and expense. Lump sum cash option. Paid out in one single lump sum of cash. Reinsurer. An arrangement by which an insurance company transfers or sells a portion of the risk to another insurer. Lump sum option. All policy proceeds paid out in a single cash settlement. Rebating. When the insurer offers money or something of value in return for the customer service. Alien insurer. An insurer domiciled in a country other than the United States. Accidental death benefit rider. Pays a multiple of the death proceeds if the cause of death is a covered accidental event. Simultaneous death. If the insured and the primary beneficiary die at approximately the same time for a common accident with no clear evidence as to who died first, the Uniform Simultaneous Death Act law will assume that the primary died first. This allows the death benefit proceeds to be paid to the contingent beneficiaries or their estate. Which of the following is the authority an insurer gives to its agents by means of a contract? A. Implied. B. Expressed. C. General. B. Morale hazard. A condition of carelessness or indifference that increases the frequency or severity of loss. Policy loan provision. Describes the conditions by which a policy owner can borrow from the policy's cash value. Other insured's rider. A term rider, covering a family member other than the insured, that is attached to the base policy covering the insured. Cash surrender option. Whole life policy owners may request an immediate cash payment of their cash values when their policies are surrendered minus any indebtedness. Endowment policy. An insurance product that pays out a lump sum after a specified term or if the insured person dies before the end of the term. Endowment policies are often used as a way of saving over the long term. Moral hazard. When the actions of the insured increase the likelihood that a loss will happen. Hazard. Anything that increases the likelihood of loss through peril. Ron, an insured under a $100,000 life insurance policy, dies during the grace period. What happens considering he has not yet paid the premium? Benefits are paid out to beneficiary, minus the premium amount. NAIC. National Association of Insurance Commissioners, an organization composed of insurance commissioners from all 50 states, the District of Columbia and the 4 U.S. territories, formed to resolve insurance regulatory issues. Is a life insurance policy taxable? A policy owner is allowed to receive tax-free an amount equal to what he or she paid into the policy over the years in form of a premium, but anything additional is taxable. Common disaster provision. Sometimes added to a policy and designed to provide an alternative beneficiary in the event that the insured as well as the original beneficiary die in the same accident. If there is not an alternate beneficiary, money will be paid to estate of policy holder. Per stirpes. A beneficiary designation where proceeds of a life insurance policy pass down to the beneficiary's children if the named beneficiary dies before the insured. At age 100, what happens to a whole life policy if the policyholder is still living? The policy is paid out as a living benefit and the policy terminates as this is when the cash value of the policy equals the death benefit amount. Whole life insurance. Insurance that is kept in force for a person's entire life and pays a benefit upon the person's death, up until age 100. Fixed period option. The proceeds are paid to a beneficiary over some fixed period of time. Term life insurance. Insurance that provides financial protection from losses resulting from a death during a definite period, or term. What are the other specific factors that can influence mortality and are also considered in a life insurance premium? Age, sex, health, occupation, habits. Valued contract. Pays a stated amount in the event of a loss. Risk pooling. A group sharing the possibility of a loss. Risk transferred from individual to group. Twisting. A form of misrepresentation in which an agent persuades an insured/owner to cancel, lapse, or switch policies, even when it's to the insured's disadvantage. Facility of payment provision. Clause permitted under a uniform health insurance policy provision allowing the company to pay up to $1 of benefits or proceeds to any relative appearing entitled to it if there is no beneficiary or if the insured or beneficiary is a minor or legally incompetent. Premium factors. Sex, age, health, occupation, habits. Per capita. A policy's proceeds are paid out only to living beneficiaries that have been named in the policy. Accelerated benefit provision. A provision in life insurance that allows for the early payment of some portion of the policy face amount should the insured suffer from a terminal illness or injury. Policy dividends. A return of part of the premiums paid at the end of the year analyzations and are generally not taxable income or guaranteed, usually if not as many insureds die as estimated. Misrepresentation. A false statement or lie about an insured's policy or a policy of a competitor. Warranty. Statement made by applicant to be totally true. Family income policy. Same as WL but W/decreasing term rider, upon death, pays monthly income for remaining term after which pays full death benefit. Automatic premium loan provision. An overdue premium is automatically borrowed from the cash value after the grace period expires bearing interest as listed in the contract. Policy rider. A legal attachment amending a policy. Additional benefits or a reduction in benefits are often incorporated in policies by the attachment of either a benefit or an exclusion rider. Waiver of premium rider. Optional rider that requires an insurer to assume payment of premiums should the insured become totally disabled for 6 months for the duration of the disability. Law of large numbers. The principle that the larger the number of individual risks in a group, the more certainty there is as to the amount of loss incurred in any period. This is based on the science of probability and the experience of mortality and morbidity statistics. Multiple protection policy. Pays a benefit of double or triple the face amount if death occurs during a specified period. If death occurs outside of that period, face value of the policy is paid out. Universal life policy. Flexible premium, payment plans, terms, and cash value. Each month a mortality charge is deducted from the cash value for the cost of the protection. Domestic insurer. An insurance company that conducts business in the state of incorporation. Insuring clause. A general statement that identifies the basic agreement between the insurance company and the insured, usually located on the first page of the policy. Estoppel. A legal impediment to denying a fact or restoring a right that has been previously waived. Indemnity contract. Pays an amount equal to the loss. Revocable beneficiary. The policyholder reserves the right to change the beneficiary designation without the beneficiary's consent. Foreign insurer. An insurer licensed to operate in a state but incorporated in another state. Cost of living rider. Allows the policy face amount to be adjusted to account for inflation based on the consumer price index. Policy owner will be billed at time additional coverage is added. Mortality factor. A measure of the number of deaths in a given population. Insurance companies use mortality tables to help predict the life expectancy and probability of death for a given group. Waiver. The voluntary relinquishment of a known legal right. Guaranteed insurability rider. Optional rider that enables the policy owner to purchase additional amounts of coverage at predetermined times without proof of insurability. Payer provision. Typically attached to juvenile insurance policies, provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the insured child reaches a specified age or until the maturity date of the contract, whichever comes first. Representation. A statement made by the applicant that he or she believes to be true to the best of their knowledge. Peril. Immediate specific event that causes a loss. Which type of risk is insurable, pure or speculative? Pure only because speculative involves a chance of gain. Beneficiary. A person who receives something good from someone else, such as an inheritance. Physical hazard. A physical condition that increases the frequency or severity of loss. Irrevocable beneficiary. A beneficiary who has a vested interest in the policy and therefore, the policy owner may not exercise certain rights without the consent of the beneficiary unless beneficiary predeceases the insured. T/F When a whole life insurance policy is in place, the owner can borrow from the cash value. True, it is not expected to be paid back, but amount taken will be deducted from earnings at death. Return of premium rider. Upon death, death benefit is paid plus the aggregate of premiums paid to date, add on to term policy only. Pure risk. Involves only the chance of loss, no possibility of a gain or profit.